Hi, and thank you for joining. My name is Mike Mills, and I'm co-founder and managing partner of the Legacy Advisor Group. Today is Tuesday, March 3rd, before market open. Monthly, I take a few minutes to review the past month in the market, touch on a few top-of-mind items, and give you our thoughts. I hope you enjoy these, and please feel free to share with your friends and family. You know, there's never a shortage of geopolitical events or market events that have taken place or are currently taking place. One of the things that we won't get into today is private credit markets. They're all over the news right now. We're following this closely and may have some of our thoughts out in the near future. As we enter this week, though, we are coming off a weekend where the U.S. and Israel have conducted a joint military operation against Iran. We are still very early into this, so any outcome is unknown at this time and could be for some time. We are, however, paying close attention to this and the impact on oil, which can lead to monetary policy changes, etc. Also, any repercussions to the oil and stock market are unknown at recording of this video. I did, however, record a video on March 2nd that you would have likely received by now with our general thoughts on the market as it relates to this. Let me add that our thoughts and prayers are with our men and women and our armed forces for a safe return home. So let's talk briefly about the market and then more specifically about a few items. Let me start by saying at last month's video recording, we were just beginning to see a sell-off settling in for a few sectors like software as a service and others. And since then, we've seen the volatility really pick up. By the time that you view this, that could have all changed. Thus is the world we invest in these days, and all the more reason to keep a long-term focus and remain diversified. This is a really good place to share a comment from Cliff Asness, a manager we work with at AQR. This comes from Mr. Asness's white paper titled The Less Efficient Market Hypothesis. This was written in September 2024. Mr. Asness writes on less efficient markets. I believe it's likely happened for multiple reasons, but technology, gamified 24/7 trading on your phone, and social media in particular are the biggest culprits. Whether this lasts forever, I can't say. It seems that over history, new technologies are eventually adapted to, and one day, maybe that adaptation renders this piece obsolete. Mr. Asness goes on to say, I think the ups and downs will be bigger and last longer, making more money for those who can stick with it long term and making it harder to do so. We completely agree with Mr. Asness and all points made in this and believe that having a stick-to-itiveness attitude is what is necessary. Regarding ups and downs, the last month in the market has been a volatile one for certain sectors, especially for software as a service companies, or SaaS. These are companies like Microsoft, Salesforce, and Shopify, to name a few. This sector has been so volatile that the term SaaSpocalypse has been referred to. This is due to disruption caused by AI, more specifically Anthropic over this last month, which is one of the leading AI companies. It's been has been the most recent name to really create disruption in different sectors. But last year, if you remember at this time, it was really DeepSeek out of China that caused a similar disruption for many companies in the tech space. AI disruption and fears of job replacement have sent all types of company stocks into volatile movement, and some with hefty drawdowns in stock price. We quite frankly attribute this to much of the media making a very big deal out of this and do not fundamentally believe there are problems nearly to the degree that media has clung to. Now, some of these stocks were trading at very high multiples, and a reset is welcome, but some of the extreme headlines by media are uncalled for and support Mr. Asness's claim in his paper regarding social media. So what are our thoughts on AI? Generally speaking, we like some of the efficiencies that it's added to our industry. It's helped greatly with some tasks that took hours of the week and now can take a fraction of the time. This has allowed us to have more time spent on other areas of our business, like financial planning for you and your family, and time in family meetings with you. For other industries, the effects are greater, and yet other industries less so. Block, for instance, recently announced layoffs due to AI. Block is a financial technology company owned by Jack Dorsey, who you may recall owned Twitter before Elon Musk acquired it. Block is made well known from some of its cash apps like Square that can be used for transacting. This really comes as no surprise to us, as there will be companies affected more than others by AI adoption. Many companies are spending big on AI. Just listen to these stats from Torsten Slok at Apollo. Hyperscaler CapEx is expected in 2026 to be at approximately $646 billion, or about 2% of US GDP. For comparison, annual growth in consumer spending is currently around $1 trillion. US hyperscaler CapEx at $646 billion is roughly equivalent to the size of GDP for Singapore, Sweden, and Argentina. For comparison, total US bank loan growth in 2025 was around $700 billion. Defense spending in 2025 was at $917 billion. Hyperscaler capex is more than the combined military spending of Germany, France, the UK, Japan, Italy, and Canada. It is roughly the same size as the market cap of the stock markets in Belgium, Denmark, and Indonesia. These spending numbers are huge, but the question is ROI, or return on investment. So far, the only investment outcome that can be found from this capex has primarily been in new data centers, which is a whole other topic in itself and how it relates to energy, and one we won't tackle today. Productivity and jobs is what are needed. We believe there will be some job loss in the long term and some business disruption. But as with always, people and businesses will adapt. It is always important to read beyond the headlines when looking at these items. The last topic I'll hit is a new term that has entered the financial world this past month and very much relates to AI. Over the years, we've had all kinds of terms like TINA and TERA. We love acronyms in the military and just as much in the business world. This new term is called HALO, and I'll attribute this term to Josh Brown, who can often be seen on the CNBC halftime report. For those of you familiar with the game or movie series, I'm not referring to that. HALO stands for heavy assets, low obsolescence. This term is in reference to companies that are not dependent on AI, but more so can use it to become more efficient. We've grown so accustomed to linking everything to AI as a society these past few years that we have to be reminded that not all companies need AI to operate. Oil companies like Exxon is an example. Walmart is another example. I could go on. The point is, despite the pullback in nearly all things AI, that does not mean the bull market is over. Rather, look closely and you will see that many of the stocks that make up the S&P 500 are doing quite well and seemingly getting better. Based on recent data for the year from Man Group, considered by most to be the oldest hedge fund in the industry, nearly 60% of S&P 500 companies year-to-date 2026 are outperforming the broad index year-to-date. This is contrary to the last few years where you can see in this chart from First Trust that 2023, 2024, and 2025, approximately 30% of companies were outperforming the index. We've said it before and we'll stick with it. Diversification matters. I think that's a good stopping place for this month. So let me end by sharing with you a recent trip I made for a family meeting with my family. My sister and I met with my parents in their mid-70s to discuss final wishes. This may seem morbid, but we've been through losses as a family, as I'm sure you have, where final wishes, were not known for family members. The meeting was extremely helpful for us and sent my sister and me away with all kinds of details that my mother and father wished for their funerals and final workings around that, as well as a discussion on beneficiaries. I highly encourage you, if you've not had this similar discussion with your family, to please do so. We're happy to facilitate that discussion here for you. As we end each video, on behalf of our team here at the Legacy Advisor Group, I want to thank you for your trust and your friendship. We take seriously the responsibility to help you and your family with your goals and family planning. Your legacy matters. We're here to help you bring it to life for generations to come. And again, to our men and women in our armed services, our prayers are with you, and God bless.